Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of George Mason University and Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, find other episodes, comment on this podcast, and find links and other information related to today's conversation. Our email address is mail@econtalk.org. We'd love to hear from you. Today is September 22nd, 2009, and my guest is William Cohan, Wall Street veteran turned author. His latest book is House of Cards, A Tale of Hubris and Wretched Excess on Wall Street. Bill, welcome to EconTalk.
Thank you for having me, Russ.
Our subject today is the subject of your book, House of Cards, The Life and Death of Bear Stearns. We just had the one-year anniversary of the bankruptcy of Lehman Brothers, which many people view as the beginning of the crisis. But for me, the beginning of the crisis was March 17th, 2008, when we read that Bear Stearns had been forced into a marriage with J.P. Morgan Chase with the Fed and Treasury as matchmaker. I want to talk about those events what led up to that, which you so colorfully chronicle in your book. Before we get there, though, I want to start with some basics. Bear Stearns was a complicated creature, especially for those of us outside of Wall Street watching from a distance. What was it doing? What does an investment bank like Bear Stearns do? How does it make its money, and where does it get its funding from?
All very good questions. I mean, if you strip it down to its essence, investment banks are in a surprising number of businesses. Like most complicated big companies, they're in, and in the case of Bear Stearns, they had variously, at various times, an asset management business where they would manage people's wealth, and had small brokerage business. They had what is traditionally thought of as an investment banking business, which means that they raise capital for corporate clients, whether it's debt or equity capital. They also provided advice on mergers and acquisitions, and then they had a very large business that ended up getting them into lots of trouble, which is what is called a fixed income sales and trading business, where they would trade and underwrite and sell securities, debt securities, among them being these mortgage-backed securities, which were sort of aggregation of people's home mortgages. That was a Wall Street innovation in the early 1980s that by the middle of this decade became a huge and profitable business on Wall Street. They had other businesses as well. They would invest in private equity deals. They would manage the funds for hedge funds and manage their trading business for hedge funds. It all added up to a 14,000 person firm and the fifth largest securities firm on Wall Street.
Yeah, one of the things they did, which is somewhat mysterious to me, and is part of the reason, although perhaps not the real reason, but part of the reason that they were there was so much focus on preventing their failure, was that they do market clearing, or I don't know how you describe their role as a intermediary for other firms in making markets. Can you help me out there?
I mean, yes, to some extent I can, with the caveat that in my 17 years on Wall Street, I was just an M&A banker. I advised on mergers and acquisitions, and as hard as I have tried to understand some of this, some of it escapes me as well, which is quite remarkable in its own right. But
yeah, there's a lot of opaqueness or opacity. I don't know what the right word is, but it's a very complicated world.
Yes, and I think there's a lot of argot. There's a lot of language that is unique to these firms, and the disclosure is minimal, and you can often never figure out how they make money, which is strange. You can figure out that Procter & Gamble makes money by selling soap and toothpaste, but you cannot figure out often how Wall Street makes money. But what firms like Bear Stearns do, and why they were, quote unquote, too big to fail ultimately, was that they have a number of counterparties they trade with. In other words, other Wall Street firms that they are enmeshed in long-term trades that are on their books, as well as with hedge funds and firms on a global basis that they trade with, so that people owe them money for trades that have not been unwound. They owe people money for trades that have not been unwound. And, of course, they're all interconnected through the way this is another question you asked, which was how do they finance themselves? And this became a huge problem for Bear Stearns at the end, is that they were very short-term oriented in their financing, which is, of course, the very nature of banking in general, which is that banks borrow short. In other words, they have, in the case of commercial banks, their depositors' money, your money, my money, that we put into a bank, which basically costs them nothing to accumulate, right? The only risk for them is that, when you want it, you can go to the ATM machine and get it. And they count on the fact that not everybody does that at once, except when, of course, occasionally in the history of mankind, everybody does want their money at once. And in effect, that's what happened here, but at an institutional level. So on the one hand, you have commercial banks who get money from their depositors, and then they lend it out to corporate customers for long term. So they borrow short and lend long. And Wall Street firms which don't have a depositor base, because they're not really, you can't go to your branch office of Bear Stearns and make a deposit because it wasn't a commercial bank, although it had some banking subsidiaries. They are forced to borrow money in the capital markets, in effect, and they start off by doing that by borrowing in what is called the commercial paper market, which is short-term unsecured borrowing. But at the end, Bear Stearns could no longer have access to that because of its own credit problems, and was forced into the short-term secured lending market. And they needed to borrow approximately $75 billion a night from these people, people like Federated Investments or Fidelity Investments. And they had maybe 25 people firms that they were getting this money from on a daily basis. And at the end, they said they weren't going to make those overnight loans to Bear Stearns anymore. And they were securing those overnight loans with the very mortgage-backed securities that they were manufacturing, that Bear Stearns was manufacturing and was in the business of trying to sell. But by March of 2008, and I know this is getting a little complicated, but by the March of 2008, Bear Stearns could no longer sell those mortgage-backed securities that it was manufacturing, and ended up having to keep them in inventory on its own balance sheet, and then in turn use those assets to secure the overnight lending it needed on a daily basis. And that whole cycle fell apart in March of 2008.
Now, the secured borrowing you're talking about that's the repurchase market, right?
Yes.
Also called the repo market. We've talked a little bit about that before on the program in a podcast with Arnold Kling. But what they were doing, it's really quite extraordinary to think about what role mortgage-backed securities played in their operations. So let me make a short partial list and see if I'm getting some picture of what happened. Incredibly, I didn't realize until I read your book how vertically integrated they were. They had a mortgage company that they owned called EMC,
right,
which was making subprime loans directly. Loans to homeowners. Mm-hmm. They had their own, this part I didn't realize either, they had their own online lending operation called Bear Direct. Do you know offhand how big that got at its peak? What kind of dollars were going through there?
No, I think I may have known at one point, but I don't.
So anyway, so they're out there Bear Stearns owns or is in the business of lending money to people who are relatively high risk, these subprime loans. They are collecting those into securities, which they are both holding on their own books as an investment, selling to others as a revenue stream, holding in hedge funds that are parts sort of Bear Stearns, that Bear Stearns is investing in as well. And then finally, and they're, of course, slicing these up as well in what are called the collateralized debt obligations, the CDOs. So they're not just holding these mortgages, they're holding them in extremely complex ways. But finally, they are funding their day-to-day flow of cash operations by this repurchase market. So they're selling these collateralized debt obligations, the CDOs and the mortgage-backed securities, to other investment banks with the promise that they'll buy them back the next day or the next week or month, some relatively short-term window. And those are the so it's technically not a loan, but it really is a loan. This repurchase market, and so they're using these extremely complex, highly profitable for a long time, but then suddenly not very profitable at all assets in all those ways. Is that a way to describe it?
Yes, I mean it is, and again, it's apologies to your listeners for whom this is not simplest to understand, but you know it's not unlike an auto manufacturer that buys its supplier to become vertically integrated.
Sure.
I mean, these mortgage-backed securities. Wall Street is very good at financial innovation, whether it's high-yield junk bonds or internet IPOs, or in this case, mortgage-backed securities that were dreamed up by a guy named Lou Ranieri at Salomon Brothers in the early 1980s. And like other financial innovations on Wall Street, once somebody comes up with a good idea, everybody rushes to copy it and reproduce it and see if they can make money from it too. And Bear Stearns was very good at making money from mortgage-backed securities. And over time, like pretty much everyone else on Wall Street, they worried that they weren't going to get enough supply
Sure.
of these mortgages. So they, as you said, they vertically integrated by buying a mortgage underwriter and also by creating this online portal for people to provide mortgages. But in that way, they were no different than Lehman, Morgan Stanley, Merrill Lynch, and others. So they all wanted to. They recognized how profitable this business of packaging up mortgages and selling them off to the world was, and so they wanted to make sure they had a steady supply of these mortgage securities. And as you pointed out, it was a great gig for a long time. And then in and around sort of the end of 2006, the beginning of 2007, the value of these mortgage-backed securities began to fall in the marketplace, primarily because the people who had borrowed the money to buy a home, probably some of them were not in a position to have actually borrowed that money and probably shouldn't have borrowed that money. And as Russ, as you have pointed out quite articulately in some of your writing, this gets back to the political mandates at the time in the beginning of the 1990s in the Clinton administration, and right up and through the two terms of the Bush administration. The people who borrowed the money to buy these homes that they probably shouldn't have borrowed ended up not being able to pay the mortgages. So the mortgages started to default. So the mortgage-backed securities that were created and manufactured and sold around the world based on these mortgages being, continuing to be paid, began to lose value. Now some in the market saw that as a buying opportunity, as when any asset declines in value. Some people view it as a selling opportunity. Some people view it as a buying opportunity. And Bear Stearns viewed it as a buying opportunity, and that was a fatal mistake as these securities lost value, and then they were using them as collateral for their overnight financing.
Well, let's
Curious turn of events, no doubt about it.
It's really it's an extraordinary story, and you tell it with great flair. It's the beginnings of one of the things you trace, and it's a very it's a fascinating piece of the puzzle, is the cultural norms at Bear Stearns. I want to put those to the side, although they're quite interesting, and I want to skip ahead from the origins of the firm, which are really quite interesting. But let's move to the summer of early part of 2007, where you, as you mentioned, the default rate starts to climb on these mortgages, and the markets start to realize, people in the market start to realize that these assets that they have been buying and selling may not be worth as much as they thought, but they're not quite sure how much that reduction is going to be, partly because they don't know what the default rate's going to go to, but also partly because these instruments are complex. People are holding different pieces of these mortgages. So one of the issues is that the ratings agencies, which I think are overrated as a cause of the crisis, but the ratings agencies did rate these as AAA, many of them, and they rated them as AAA because of the tranching system. That is, that they anticipated some defaults on the riskier parts of the package, but there was a sort of a firewall. The top of the package, the so-called senior tranches, were insulated from these defaults. So what went wrong in this time period? Did the default rates get higher than they anticipated?
Yes, that was very much part of it. Historical default rates started moving up, as you know, and the rating agencies were aware of this, although it took them by surprise. I mean, I had written an article a few months back in Fortune about McGraw-Hill and S&P and their role in all of this, and the head of S&P at that time told me that he was surprised at how swiftly the default rates had moved up and took them by surprise. But you know, it was also, I think, sort of a bit of false comfort that everyone was taking from this, high degree of structuring. And if you ever are so bored in your own life, and I'm sure you wouldn't be, that you wanted to ever read one of these mortgage-backed securities documents, there's all this, incomprehensible language. Of course, that's standard, as we know, in any SEC document. But, there's this sort of false sense of security that you get that they were trying to portray, by tranching out all of these levels of these securities and assigning AAA ratings to the top of them, which, by the way, the underwriters were paying for with the rating agencies.
Right.
In other words,
everybody knew that. So I always find that, there is an obvious conflict of interest there, but everyone was aware of that conflict of interest. That wasn't a secret.
That is true. But, for instance, and not every mortgage-backed security is a little different, but, some of them would be made up of second mortgages. So, people would have a first mortgage on their home, then they would take out a second mortgage. So there'd be a second mortgage on a whole series of homes of people who didn't have the best credit ratings to begin with.
Yeah.
And then that would all be packaged up, and the senior-most part of that was rated AAA. Well, I mean, to me, that is what I would call sort of false sense of security.
Yeah, my analogy is to the Titanic. It was the ship that couldn't sink because if there was a leak, the damage would be limited to just this one area. It's the same kind of hubris and logic and overconfidence with these securities. The idea was, well, sure, there's going to be some defaults, but they'll be the overall package will be safe because there's no way that everybody's going to default. It's a national housing market. I mean, there isn't a national housing market. There's regional things that'll go wrong. There might be a spike up in unemployment in Detroit, but that's not going to hurt the whole package. And that was there was a surprise there for sure. But let's go back to the summer, and this is even more complicated, but it's worth getting into for a little bit because I found it really rather incredible, because you hear about this, that in the summer of '07, the first warning sign that Bear Stearns was in trouble came about when their two hedge funds had trouble. And without going into all of the details, which we could spend 4 or 5 hours on, no doubt, try to explain the relationship between the parent company, Bear Stearns, and these hedge funds, because I always assumed when I would read about them that, well, Bear Stearns, and like you say, they manage people's money. They had an asset management thing. I just assumed these hedge funds were an integral part of Bear Stearns. They actually weren't. And as you point out in the book, for a long time, Bear Stearns' total commitment to these funds, which were in the billions, was actually only $20 million. It later went up to a $45 million stake. So when they went bust because they were holding so many mortgage-backed securities that were defaulting, on the surface, it would seem not to have any impact on Bear Stearns because Bear Stearns' stake in these funds were so small. What happened there that changed that and started the slow death spiral, which was about, 9 months later?
Yeah, I mean, it's a fascinating decision by the top management of Bear Stearns. They were called Bear Stearns hedge funds, and they had sort of weird names, typical Wall Street jargon kind of names, but they were part of Bear Stearns Asset Management. And you're right, Bear Stearns itself had a small investment in it, and basically they sold these hedge funds because everybody wanted to invest in hedge funds at that. These things get crazy. People think that they can
automatic money,
automatic money, right? So
20% rate of return.
So Bear Stearns, of course, figured not only they had a couple of problems to solve. They had people inside the firm who wanted to be hedge fund managers, and they didn't want to lose them, so they made them hedge fund managers, even though they had no hedge fund management experience, like this guy Ralph Cioffi and Matthew Tanine, who ran these funds, and whose trial in federal court in Brooklyn is going to begin in a few weeks. And so that was one problem they wanted to solve. The other problem is that they had a lot of clients and investors who wanted to be invested in hedge funds. So it was a perfect way to, for them to think about making money. But what happened, of course, fatally, as the hedge funds started to fall apart in June of 2007, and they ended up being liquidated in July of 2007, is that investors and clients expect, because they're associated with Bear Stearns, that somehow Bear Stearns will step up, and if things go wrong, bail out the investors. Bear Stearns, and Goldman Sachs had a similar situation with their alpha funds a few months earlier, and so Goldman Sachs did step up and bail out some of their investors, and a lot of the people in the Bear Stearns hedge fund wanted Bear Stearns to do the same thing. Now, Bear Stearns decided not to do that. They decided not to bail out the investors, and the investors lost approximately $1.6 billion, their entire investment. But what they did do, which was a fatal mistake, was they bailed out the overnight repo lenders, just like Bear Stearns itself was reliant on overnight financing for its very existence to the tune of $75 billion a night. The hedge funds were in the repo market as well, using the mortgage securities that they had invested in the hedge funds as collateral for overnight financing that allowed them to operate and to make other investments, et cetera, et cetera. And what happened in July of '07, which was fatal, ultimately, was that the management committee of Bear Stearns, although Jimmy Kane dissented, the CEO, maybe one of his only correct thought processes at that time, was that the Bear Stearns decided it had to take out and become the repo lender to the hedge funds, become the overnight lender to the hedge funds, because all the other overnight lenders, which were basically the rest of Wall Street firms, wanted their money back. So Bear Stearns, the parent, paid those lenders their money, by and large, not all of them, but by and large, and then became the overnight financer to the hedge funds. And then,
which meant they were holding as collateral the crummy, toxic stuff that the hedge fund had bought, and which investors were getting increasingly, and lenders increasingly antsy about.
Correct. And then when the funds were liquidated at the end of July, Bear Stearns, the parent, ended up getting even more of this mortgage-backed securities on their balance sheet than they already had, which they already had more than they could handle at the moment anyway, but then they ended up taking another, $1.5 billion of this stuff onto their balance sheet. And then in the fall, the third quarter of 2007, they experienced the first loss in their 84-year history as a result of writing down the value of the collateral, the mortgage-backed securities they had just taken onto their balance sheet. And this, of course, led to the eventual death spiral.
So I want to just go back for a minute and do a little bit of the nuts and bolts again, because I knew nothing about this, and it really helped me understand some of what had happened. So you've got these people, Shafi and Tanin, running these Bear Stearns hedge funds that are sort of Bear Stearns, sort of not Bear Stearns. Bear Stearns has their name on them. They're part of Bear Stearns Asset Management, a piece of Bear Stearns. But the parent company is only tangentially involved other than as oversight and putting their brand name on it. These hedge funds are operating, I mean, most of us don't have any experience with this. They take in money from clients and they manage it, but every once in a while they're going to see opportunities and they're going to want more cash than they have in their asset base, in their client base. So they're going to borrow money to make trades that they otherwise wouldn't be able to make to enhance the returns to those clients. And they're going to do that with borrowed money. And the lenders, and this is the part I think is so important because I want to see how the story carries through to Bear Stearns itself. These hedge funds are borrowing money not from individual investors, not from clients, but from the standard great names on Wall Street that everybody else is borrowing from. Goldman, J.P. Morgan, Lehman, Credit Suisse, et cetera, correct?
Correct.
So there's a point in the story, I mean, this is just a beautiful, well, not beautiful is not the right word. Maybe it's poignant, maybe it's powerful, I don't know. But there's a credible moment in your story where the hedge funds are basically, they're basically defunct in that the assets that they've been holding to cover their loans, the collateral, are worth dramatically less than they thought. Instead of being 100 cents on the dollar or even 98 or 97, it looks like it might be more like 50 cents or 30 cents because of the default rates we've been talking about going up. So there's a meeting where all the lenders to these funds who are clearly not going to all get their money back, or maybe none of them are going to get their money back, are in a room with the Bear Stearns parent group saying, hey, what's going on here? We've lent you a lot of money, and it's hundreds of millions and sometimes billions of dollars. We lent you that on the condition that the collateral you gave us was good. It turns out it's not. So what do we do now? And the answer that Jimmy Kane gives when you say he said no, the answer is, well, you paid your money, you took your chances. And the beautiful or powerful or poignant moment is that this is a replay of what had happened 9 years before in 1998 when Long-Term Capital Management, a similarly highly leveraged hedge fund, had basically said we can't keep our promises, and the Fed orchestrates a bailout of its creditors that all of Wall Street participates in except for one firm, and that's Bear Stearns. So now Bear Stearns is trying to do the exact same thing. The irony is that they did 9 years before. The problem is it's their firm. It's unbelievable. And as you report, the other Bear Stearns executives, other than Kane, other than the CEO, said, we can't do this. So am I right in that? Am I getting the story right? And is that?
Well, it was actually Kane who said, just as he had 9 years earlier with Long-Term Capital Management, he's the one that said we can't do this. He's the one who said, I think as you said, you paid your money to this fund, you lent to this fund, you're big boys, you're Merrill Lynch, you're Credit Suisse, you took your chances and it didn't work out, so too bad for you. And his argument was, look, they're big boys, just like he told long-term capital management, we've done our thing. We've supported this as much as we're going to. At that point, they had $45 million on the line. But unfortunately, the rest of the executive management team, which was, a couple of committees, was about 20 people, voted Jimmy Cain down, and Bear agreed to become, this is how the parent company got involved with the hedge funds, agreed to become the overnight lender to the funds at, of course, the exact wrong moment. And they ended up paying out all the other lenders who instead were facing a huge loss, got most of their money back. And then Bear Stearns ended up losing everything they had just put in literally a month later.
Now, so that was July. Yes. They are going to live for 9 more months.
Yes.
And in those 9 months, here's the part that I find fascinating, and we'll get to the incentives that these executives are facing all along. But during those 9 months, as you say, Bear Stearns they're holding a lot of these mortgage-backed securities on their own books directly that they had either issued themselves or bought from other issuers. They are essentially guaranteeing implicitly the holdings of their hedge fund and compensating or repaying the lenders who had financed those. They're doing all that with their own borrowed money. They themselves continue to be extremely active in the overnight and short-term borrowing market, correct?
Yes. And hence the title of the book, House of Cards, because it literally was, borrowing from Peter to pay Paul. And it, I view it as, you mentioned, they survived for another 9 months. It's not unlike, sadly, if somebody gets a terminal illness and they're informed and, they carry on for a period of time and then they don't. And I think that's what the situation was here. I mean, certainly Bear kind of, if they didn't know they were in trouble by the spring of 2007, which I suspect they didn't really, there's no question that they should have known, and I think some people at Bear did know, although not the top management for some reason, or if they knew, they pretended not to know, that by the summer of 2007, they were in serious trouble. And what began to happen was that they could no longer, they weren't big on, long-term borrowing anyway, but their short-term borrowing, which they did because it was less expensive than long-term borrowing, which gets back to the management's incentives, the market basically wouldn't provide them even longer-term, short-term financing, if you know what I mean. In other words,
a few months.
Their lending really got short. The market said, you know what, we don't like your credit anymore. We're going to really shorten up the amount of money that we, the time frame of the money that we lend you.
Because we think you're going to be here tomorrow, but you're probably going to be here tomorrow, but you might not be here in 3 months.
Right, which is actually an incredible concept in itself, because the firm had been around for 84 years and had never had a losing quarter. And while Wall Street has always been a dangerous place, there hadn't been a calamitous incident with a firm going out of business since 91 when Drexel went out of business. But at least there you could say, well, that there was may have been a criminal enterprise with Milken and the junk bonds and all that. Basically, firms started to, after they all went public, they got bigger and bigger and more entwined with other firms, and then we lead to where we are now, which is too big to fail. But no firm that had gone public and that was this big, had even been on the brink of failure, let alone fallen into the abyss. And then in the space of 6 months, you've got all these firms falling into the abyss. But the fact that the market was saying, in effect, we think you'll be here tomorrow, but not 3 months from now, was incredible in itself. And then by March of 2008, as I pointed out in the book. I mean, hedge funds and other big investors were making bets, short-term bets, that Bear's stock, by buying puts, which was essentially a short-term bet against a company's stock, would be out of existence, in a week. And it turned out that they were absolutely right, which raises all sorts of questions on its own.
Yeah, but on this, this issue of when did they know, and how vivid was their knowledge of their precariousness of their position? When you talk to them, I didn't notice it in the book, and I know this is not the strong suit of these kind of people, but have you thought about, or did you ask them what they might have done differently? Obviously, some of them regret the backing of the hedge funds, but even if they hadn't backed the hedge funds, even if they'd said twist in the wind to their other Wall Street firms, there was a real chance at that point that out of pure spite, the rest of the firms on Wall Street wouldn't play ball with them, wouldn't clear with them, wouldn't lend to Bear Stearns overnight anyway, and it might have just sped the process up. But once that decision was made, what might Bear have done differently? Have you thought about that? Did they think about it?
Yes, I mean,
they're not a very introspective group of folks, or at least they don't share it.
Given that this happened, I've now written a new afterword for the paperback edition of the book, which is coming out in January, and explored that very question with Alan Schwartz, who was the CEO of the firm at the end, and for 3 months. And his basic conclusion, and he's not wrong. And
he'd been there for a long, long time. It wasn't like he just showed up.
For
20, 30 years, right?
20, 30 years. His conclusion, and in the senior executive position for 15 of those years, his conclusion was that if you really cut through it all, and you could talk about maybe we could have bought Neuberger and Berman, or bought this business or that business, or gotten bigger in this business, or had lengthened out our financing, whatever it was. His conclusion, as recently as a month ago, was that we had no choice but to have sold. In other words, our only way out of this was to have sold, and they didn't do that. And what he means by that is that the whole business plan of the firm, going back many years, had been so heavily dependent on the fixed income group and the manufacture of these debt securities, of which they made a tremendous amount of money for a very long time and paid themselves huge compensation over a very long time. At one point, Jimmy Cain's stock in Bear Stearns was worth more than $1 billion, and he was the only Wall Street CEO whose stock was worth more, his personal stock was worth more than $1 billion, and he took great pride in that. So, hubris and ego, of course, get in the way of this, to say nothing of greed. And they didn't want to change their business plan. They liked it because it was making them a lot of money. And by the time they realized that they had infected themselves with cancer, it was too late to do anything about it.
I'm thinking about it on a more day-to-day basis. One of the things I've been thinking, there are two issues I've been thinking about is the underlying cause of the crisis. One is the leverage, the amount of borrowing. And I'm curious how, do you have any feel for how long that had gone on? As you point out in the book, Bear Stearns at the end is typically leveraged in a month anywhere from 30 to 50 to 1, meaning that $1 to $3 of every $100 are their assets. The other $97 to $99 per 100 are borrowed.
It would be as if you could buy a house putting down 2% of the purchase price in equity, and borrow the rest.
Which, of course, you could during this time, which is part of the problem. What I'm starting to see this whole phenomenon is it was a lot of people playing with other people's money. The puzzle then is, why did the other people finance those bets? But I'm thinking in the short run, if you're leveraged 30 to 1 or 40 to 1 or 50 to 1, the obvious thought to do to prevent death is to retrench. It's to raise capital. It's to lower the amount you have to borrow so that if the bad times do come, it's not a death blow. They did not do that. And neither did Lehman Brothers in the aftermath of Bear Stearns' collapse, which is strange because Lehman was also had a very similar balance sheet.
Yes, I mean, there's no question Bear Stearns did not do that at all.
They said they did, by the way. You quote in the book many times they'd claim their capital cushion is large, it's healthy. It wasn't true.
Right. I mean, by the SEC guidelines, that is true. But so, when did the leverage start getting out of control? The leverage started getting really out of control in June of 2004 when the SEC passed new guidelines on leverage for Wall Street, which Wall Street had been lobbying for ever since the repeal of the Glass-Steagall Act in 1999, because they felt that, the commercial banks were now able to compete directly with them, which is something that had been going on through much of the 90s anyway, but now it was a fact, it was the law of the land, and they figured the way that they could make more money with this new competition was to have more leverage. And banks, of course, being regulated by the Fed, could only have, say 10 to 12 times leverage. Investment banks not regulated by the Fed, but regulated by the SEC, lobbied for that change, got the SEC to agree to the change in June of 2004, and as the quid pro quo, the SEC was supposed to do a lot more monitoring of what went on at these firms. Unfortunately, the SEC forgot to do that until it was too late. So you have the first appearance of the SEC at Bear Stearns in August of 2007. More than 3 years later, if they had been monitoring it closely all along, maybe they would have forced them to bring down the leverage, but they didn't.
But as you point out, even at that meeting, they kind of went like, "Oh, that's okay."
Yeah, of course. It was the same weekend that they were, firing Warren Spector, the head of the fixed income group, and that KKR, the private equity firm, was in there offering to put more capital into Bear Stearns. This was in August of 2007. Now, the executive committee of Bear Stearns, which was compensated on a return on equity calculation, which meant that they wanted to figure out a way to be as profitable as they could using as little capital as they could, and therefore that fraction to be high, in other words, to maximize that fraction, they needed to minimize the denominator of the fraction. In other words, minimize the amount of capital they had in the firm. So they constantly refused capital from everybody who was trying to throw it at them during the last year of its existence. And this was, another fatal flaw that the firm made. Alan Schwartz would argue that it was, too late already. Now, it might have been, but to not take capital from anyone so that you could make your return on equity calculation high so that you could pay yourself, as much as possible, was utterly short-sighted.
Well, let's turn to those incentives because we have. I will be interviewing some folks soon for this program on this issue explicitly, but I want to focus in on Bear Stearns. From the outside, I always, and we've talked to other guests on the show about this issue, and they take a different position now than I've come to. But from the outside, it looks like, well, come on, Bear Stearns didn't want to kill itself. Why would they leverage themselves so much? Why would they be so at risk of death? And let me just mention, when you're leveraged, 50 to 1, and you have $2 for every 98 that you spent, every 100 you spend, and the 98's borrowed, a small change in the value of your assets means you're going to be insolvent, that your collateral is no longer covering the loan. And that's basically what happened to most of the firms that we've been talking about who didn't make it, Merrill Lynch and Lehman and AIG. They were so leveraged that these changes in asset value, which normally just would have been a bad quarter, ended up being the end of the firm. The standard argument is, well, Bear Stearns didn't want that to happen. They didn't want it. Why wouldn't they take enough care on that? Why wasn't there enough incentive for them to take care? And I'm starting to come to the view that those incentives weren't there because they were counting on being bailed out. And along the way, they made an enormous amount of money, and they didn't pay much of a price. What do you think of that?
Well, I think that the circumstances surrounding each firm are a little different. When it came to Bear Stearns, I don't think they thought about whether they would be bailed out or not bailed out, because that whole concept hadn't even come up yet. I don't think it was conceivable to them that anything like what happened could have happened. In other words, I just don't think they thought about it, which is fascinating in itself. I think they did not understand, and for all their vaunted risk management skills, I don't think they understood how vulnerable they had made their firm. I don't think they understood at the executive committee level, especially after they fired Warren Spector in August 2007, how risky the firm's business plan was between manufacturing these mortgage-backed securities and then using those securities as collateral in the overnight financing market, how risky they had become. And let alone even conceived of the fact that the overnight lenders could say, in March of 2008, we're not going to do business with you anymore.
Right, but those overnight lenders were, of course, aware that it was their money on the line, not Bear Stearns as much as anything else. It was their money, and they kept lending that money. Now, I'm not going to suggest that they sat around and said, well, this is risk-free, because the government will end up stepping in. Of course, the government does step in, and those lenders are insulated from the cost. The shareholders are not, but the creditors and counterparties who had financed all of those bad bets ended up getting most of their money back. Seems like a rather bad incentive.
I mean, I think that, as you alluded to before, I mean, since these firms started going public, in 1970 is when this firm Donaldson, Lufkin, Jane Rent went public, and Bear Stearns went public in 1985. What had been their own money, what had been the individual partners' money that was on the line, and their entire net worth that was on the line on a day-to-day basis, became other people's money on the line, shareholders, creditors. And even though these guys could say, well, we still owned 40% of the equity of this firm, and even though Jimmy Keynes could say, I had $1 billion worth of equity in Bear Stearns, and you would think that would be plenty of incentive, that all the incentive that I needed to monitor things closely. In fact, over the years, he had taken out, several hundred millions of dollars in cash that he had, tucked away, and knew that, he was essentially playing with the house's money.
Yep.
As he said to me, losing $1 billion wasn't going to affect me and the way I lived. It's going to affect, my heirs.
And not that much, because he said this is my favorite quote in the book, he says he was left with a mere $600 million. A mere
$600 million, which was probably an exaggeration, of which there was no way I could verify, right. But nevertheless.
I've seen 400 mentioned.
Right. So even if it was 400, I mean, this is a guy who, as he likes to say, grew up in the north side of Chicago. His father was a patent attorney, and, in the 40s and 50s, never made more than $75,000 a year, which seemed like a lot to me, especially at that time.
You bet.
And, moved to New York to become a professional bridge player, making what he hoped would be $500 a week. And now had made, had socked away several $100 million. So, he had everything he wanted. I mean, and had, completely lost sight and wasn't that good a risk manager to begin with. In fact, probably had no conception of what the risks that the firm was taking, although he certainly was aware of how profitable and how wealthy he was becoming.
Yeah, and as you point out, his salary was quite substantial, in the tens, depends. Sometimes his salary was in the form of stock, sometimes it was cash and stock, sometimes it was cash, stock, and options. Right. But over the years, as you say, he was investing some large chunk of that money elsewhere as a backstop, and he wasn't alone. I think it's important to mention this. This has been the puzzle for me, and I asked Ricardo Ribanato, who's the chief risk officer of the Royal Bank of Scotland, which had a similar meltdown and was taken over by the Bank of England. They went bankrupt. And his claim was, well, these people lost a lot of money. And of course they did. He said, they didn't think that they were going to get bailed out. They weren't counting on being bailed out. And all that's true. I don't think they sat around and said, let's roll the dice because we won't have to pay any of the costs. But the fact is, they didn't pay much of the costs. And while Jimmy Cain lost $1 billion on paper from the stock's high of 172 and change to its it's a great story in the book where he ends up selling not at the $2 price or even the ultimate $10 price, but at the little higher than that in the week where J.P. Morgan's and the Treasury and the Fed and the public are arguing and Bear stockholders are arguing. So he ends up selling his 6+ million shares for $61 million instead of the 1-point-something billion it was worth 15 months before. So it looks like he takes an enormous loss. But, of course, those paper gains he had, he couldn't cash those out. He was the CEO. When he gets fired or resigns, whatever you want to call it, in December of 07, he explicitly is told he can't sell the stock.
He agrees not to sell.
He agrees not to sell, and it would be rather awkward to sell it. When at that point it's, 70 or so. Mm-hmm. So he has to settle, poor guy, for his whatever hundreds of millions of dollars. And the other executives, or I assume, and I'd like to hear you speak to this, they had a similar nest egg that they had accumulated over the years. They didn't get wiped out like you'd think from the equity losses.
Well, that's absolutely correct. I mean, that's the flaw on all of Wall Street at the moment. I mean, all this so much is made of the equity participation that these guys have in their company's stock. Well, what people aren't focusing on is the fact that, even if 50% of their compensation is in the stock of the company, the other 50% is in cash. And by the way, that cash portion alone is, many multiples of what most people in any given year would expect to make in a lifetime.
Yeah.
So, I mean, the amount of pay on Wall Street is completely out of whack compared to other noble professions, and so that when you're getting only 50% of that in cash, and you can say, well, I'm rolling another 50% in the equity of my company, and so of course I care about it. The fact of the matter is they're using their 50% in cash to live a lifestyle that other people could only dream about.
And, of course, many of them sell pieces of that equity along the way and cash it out. You mentioned Warren Spector, who through political machinations of Cain is forced to sell a large chunk. That turned out to be a really good deal for him. At the time, he wasn't happy about it, but he made, I assume, hundreds of millions of dollars from those.
Something like $300 or $400 million.
So the incentives, as one economist put it to me, if anything, the stock is the cover for what they do rather than the stick or the carrot.
I agree with that. It makes everything else they do palatable to the general public.
Right, because they say, well, we're in it with you, but they're not really.
But they're not.
Yeah.
Once upon a time, by the way, Russ, they were in it with us, so to speak. Or we weren't even in it. They were whole in it themselves when these were private partnerships and their whole net worths were on the line. Therefore, they were much more careful about the decisions that they made and the business lines that they got into. I mean, I worked at Lazard for 6 years, and that was a private partnership from 1848 until 2005. And there was a reason that Lazard stayed solely in the business of providing M&A advice, because no capital was required, and the only thing at risk was basically your reputation. There was no capital at risk. And you weren't using other people's money to make big bets while paying yourself big salaries and bonuses, along the way. Any money that you made from your own intellectual capital. And you had to redo it every single year. Well, the rest of Wall Street, used to be like Lazard. Lazard used to be like the rest of Wall Street until, they started going public, taking money from other people, creditors, investors, equity holders, and making these huge bets, risky bets, knowing all along that the whole deal, the whole gamble, the whole bet was to make as much revenue as you possibly could in any given quarter, in any given year, so that your bonus would be maxed out.
Yeah, and I think it's important to, you and I are talking about it, that they're playing with our money, not just their own, but of course they were really playing with each other's money, and our money came into it as taxpayers, not as investors. We didn't share in the good times. Their fellow funders shared in those good times, and we've now paid for the consequences of that rather than the people who made the bets or funded the bets. And I think that's really damaging to democracy and capitalism. I'm very depressed about it. The other thing I want to mention, though, and get your reaction to is I think the other mistake we make, besides saying, oh, well, they had a stake in it, they had all this equity. Well, we're focusing on the firms whose bets didn't turn out. It's always uncertain. Merrill Lynch and Bear and Lehman didn't sit around saying, well, we'll drive our companies into bankruptcy. Maybe, but we'll make money along the way. They didn't. They rolled the dice. And the point is that other firms that did something similar, they didn't go bankrupt. So at Goldman and at J.P. Morgan Chase, who did a lot of the same things, just not quite as much, if I understand it correctly, they had their cake and ate it too. They made the loans. They got compensated, as Goldman has for the AIG through the AIG bailout, and they make the stock returns.
Yes, Goldman is smart enough, as they like to say, to be long-term greedy. So in December of 2006, as I've written about, and others have too, they made the decision to, in effect, pull back from the mortgage securities market and trading of mortgage securities, and to say nothing of using them as collateral. They just made a firm-wide decision to pull back from all that. Turned out to be the right decision. And they are, flying high today as a result of that decision in December of 2006. I believe that was really the key decision in all of this, in terms of Wall Street executives thinking through this issue and the potential risks that were associated. Goldman made this decision, pulled back, and that should have been a signal to the market that some very smart guys had changed their mind about all of this. Unfortunately, at the rest of Wall Street, it was just an opportunity to double down, and which is exactly what the rest of them did. And
to look better than Goldman for a while, because those quarterly returns for a while were better than theirs because of the risks.
Yes, that's true. And Goldman also, was less reliant on the short-term overnight funding market. And yes, it cost them more in interest payments to get longer-term financing, and as accordingly, they were less profitable than they could have been had they decided to be more involved in the short-term financing market. But they also didn't want to give their short-term overnight lenders a vote every night about whether to keep doing business with them. So, there are differentiations on Wall Street. You could enter into the whole argument of, what did Goldman know and when did it know it, and it's all friends in Washington, et cetera. But, without getting into all of that, if you just look at what they did at 85 Broad Street that was different than what other firms did, there were big differences, and they benefited as a result. And, you have to keep reminding yourself that Wall Street is not monolithic. It's a bunch of people making decisions based on incentives that they have individually, and that can lead to a series of bad decisions, which is what happened in this crisis. And by the way, it wasn't the first time that we found ourselves in this situation on Wall Street. It's like the 10th time since these firms started going public, and that's why I get so, outraged when I think about the fact that we're going back to that so quickly without any reform of this system.
Why do you say it's the 10th time? What else? What other episodes are you thinking of?
I'm thinking of, a month after I started on Wall Street, which was in September of '87. We had the crash of October of '87, when the market went down 22.6% in one day, and grown men were crying in front of Quotron machines and talking about how they would never let this happen again. Well, that happened because of the bubble that was created in high-yield junk bonds, and the amount of money that was being borrowed so that, to pump up this whole leveraged buyout business. That was another bubble that formed. Another bubble that formed was internet IPOs in the late 90s. And there was a bubble in emerging telecom debt, and there were crises in East Asia and Mexico, and, the way that the deadly combination of financial innovation on Wall Street and the compensation system on Wall Street, and the fact that they're using other people's money because of being public companies, has created this seemingly never-ending cycle of boom and bust and bubbles being inflated and bursting. And we haven't changed a thing about that, even though we've gone through this traumatic experience.
Yeah, I know. Well, we're gonna continue to talk about this issue for the next in the coming weeks and months, because I think it's a key part of the problem that hasn't been fully both explored publicly or certainly here. Before we close, you interviewed a lot of colorful and extraordinary people, flawed and brilliant and clever and naive and blind and all kinds of things. What's happened to those folks? One of the things I also think we often forget, we say, oh, Bear Stearns died. There's something embarrassing about that for these folks. I'm sure their cocktail party conversation is not quite as sparkling because they presided or were at the on the watch of the death of an 85-year-old company. But they didn't die. We've talked about Jimmy Cain, who was left with a mere whatever it is, $400 to $600 million. What are some of the other executives doing, and how are their balance sheets that you know of?
Yeah, well, in truth, their net worths have taken a hit, but probably not as much as you'd expect. I mean, Jimmy Cain who is officially retired. Still playing a lot of bridge at the national level. His net worth took a hit, but most of the other executives at Bear Stearns had been selling stock right along. Jimmy Cain, had been selling stock too, but even though he would like you to believe that he hadn't, others had been selling much more. So you've got Warren Spector, who was fired in August of 2007. It was probably worth $300 or $400 million. Alan Schwartz, who was the CEO at the end, probably something like the same zip code, maybe less. He's now a senior executive at something called Guggenheim Partners, where he's trying to, as he has said, recreate a mini Bear Stearns there. Ace Greenberg, who was the longtime CEO before Jimmy Cain, and then remained on the executive committee during Jimmy Cain's reign, and then afterwards is still at J.P. Morgan Chase. I think he had been probably the most aggressive seller of the stock all along, and he's supposedly writing a book about all this. Probably the one guy who was on the executive committee who doesn't get mentioned as much was the CFO, Sam Molinaro. He has not found new work, and I think he probably is suffering more than his colleagues. But it's interesting that because of death order here, the fact that Bear Stearns went out of business first, ended up getting $10 a share in stock in J.P. Morgan stock, which is J.P. Morgan stock has rebounded. So a lot of shareholders and employees who own the stock have actually, I wouldn't say benefited, but didn't nearly lose as much as say Lehman shareholders who lost everything, and the creditors of Bear Stearns got bailed out at 100 cents on the dollar, versus the Lehman creditors who got about 10% on
slightly
the dollar
less. Yeah.
And a lot of the people at Bear Stearns have managed to get new jobs, not nearly making as much as they had been or lucrative, and a lot of them seem sort of a bit depressed by all that's happened, which I can understand, but a lot of them have moved on and chalked it up.
My guest today has been William Cohan, author of House of Cards. He's also the author, he mentioned his book on Lazard, The Last Tycoons, which I look forward to reading. Bill, thanks for being part of EconTalk.
My pleasure, Russ. Thank you for having me.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.